Hi, I'm TJ Kistner, Chief Investment Officer at Retirement Plan Advisors. Today I'll go through market performance for the second quarter and discuss our forward-looking views. We hope you find the discussion helpful and informative. The second quarter kicked off with a large sell-off in the S&P 500 as the announcement of global tariffs on April 2nd far exceeded the market's expectations. From its peak in February, the S&P 500 dropped almost 20% through April 8th. But after a 90-day pause on tariffs was announced, we saw a remarkably strong and fast recovery in U.S. stocks as trade uncertainty eased and investor confidence returned. In fact, the S&P 500 gained 25% from April 8th through the end of the quarter, bringing its year-to-date return to over 6% and now sits at all-time highs. The rebound during the quarter was broad-based as U.S. large cap, small cap, international, and emerging markets all rallied strongly. Small caps continue to lag and are slightly negative on a year-to-date basis. Outside the U.S., returns have been strong, particularly in Europe. A weaker dollar and fiscal stimulus announcements in Germany have led to a resurgence in those markets. In addition, a rebound in Chinese tech stocks and easing trade tensions with the U.S. has led to outperformance against the S&P 500. Bond markets have delivered solid returns throughout the year and provided much-needed diversification during the equity volatility we saw in April. The yield curve has been relatively range-bound as investors wait to see if the Federal Reserve will resume interest rate cuts later in the year. This has led to resilient returns in bonds, primarily driven by higher overall interest rates and coupons. We viewed the volatility late in the first quarter as a buying opportunity and increased equity exposure across a number of our portfolios, which has been a strong tailwind for our performance. As we look ahead, we think the U.S. economy continues to be on solid footing as consumers remain in a healthy financial situation and willing to spend. But we also recognize there continue to be a number of risks related to trade policy, geopolitical uncertainty, and inflation that could impact markets. We also think the market may be approaching levels where very little risk and uncertainty is being priced in, which can create downside risk. Volatility may persist, but as long-term investors, we remain disciplined, diversified, and focused on our clients' goals, not the headlines. Thank you for listening. We hope you found the information helpful. And remember, the future is better than you think.